Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and we take a look at investing. I'm Stacy Smith, and I ask that you subscribe or say that you like this podcast on whatever platform you happen to be using. Well, there are a host of economic reports this week, along with the Fed meeting. We'll talk about that. High mortgage rates have impacted the housing market. We'll also talk about how housing-related stocks are faring now, and should world events affect the way you invest? That's coming up in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Frank Rossetti of HF Management Company, Kim Forrest of Boca Capital Partners, Michael Godwin of Fergasso Advisors. Kerry Coghill of Coghill Investment Strategies in Pittsburgh could not be with us today, so joining us again is Shana Bielik of Coghill Investment Strategies. Shana, thanks for joining us once again. You always do a superb job when you fill in for Kerry. Thanks for joining us.
Thank you.
Well, except for a pullback here or there, the markets continue to seem to stair step toward their all-time highs. The march upward is something investors like to see, but with renewed conflict in the Middle East, heightened tensions between Pakistan and India, and the on-again and off-again tariffs, Shana, what are you telling your clients, or are they even concerned about these sort of things?
Yeah, the clients certainly are concerned, Stacy. I think what the market is telling us, especially this morning, and things could change when we get out of this recording, but I think the markets are proving to be a bit resilient, but whether that's tariff-related, political, but right now with the geopolitical uncertainty, I think that really has everyone kind of a bit frazzled. What we try to do in times like this is take it back to history, right? And we'll look at other periods of conflict, like take it back to when Russia invaded Ukraine. And we look at what was the drawdown at that period. And for instance, when Russia invaded Ukraine that day, the market was actually positive. And 1 year later, the market was down. It was down about 5%. But remember, that was 2022, and we had other issues that were also occurring in the market. If you look more recently in 2023 with Israel and Hamas war, the day that occurred, the market was actually positive, and 1 year later, the market was up 34%. Now, they're not all that stories that are great. Of course, in 9/11, one day the market was down 5%, and 1 year later, it was still down 13%. So then we look at time frame of how long does it take us to recover. And in that time, it was about 30 days until the market recovered. So all of this to say is that we try to talk to our clients about other periods in history. And I think there's still risks and things could certainly be different. You remember the line that we always use is that history doesn't often repeat itself, but it does rhyme. So really, I think it's just about talking clients through what has happened in history and letting them know that really stay focused on the long term, because really that's what we're managing the money for. And as we started out this year knowing that we anticipated a more volatile year, we did move some things around in the portfolio to become a bit more defensive or set cash aside. So it's really keeping the client focused on the long term, and I think that's really helpful.
As far as history
go ahead.
repeating itself, I think that if you look back at the 100 years, that what was so great about the 20th century? We had World War I, we had a depression that lasted 10 years. We had a stock market that went basically flat from 29 to I think 50 or 51, somewhere in there, before it broke to new highs. We had Vietnam. We had Richard Nixon's time with all that chaos. We had double-digit inflations. We had bank collapses, many of them. We had all these things, and yet, at the end of the day, the market went up about 10% a year on average. So if you look at that broad history, I can't imagine that things are going to happen much differently the next 100 years than the last 100 years. And it'll just be new stuff led by AI, or technology or quantum computing or something that I haven't read about yet, which is probably probable. So that being said, long term, 50 some years later, as an investor and an advisor, I can't do short term. Just before we got on the air, Iran wants to talk.
It's hard to do short term, I agree, Frank, but it's also, if I told my clients, don't, set it and forget it for the next 100 years, they would say, I'm going to be long gone in 100 years' time. So sometimes
You don't
tough
know
to do
that.
that. I will be long gone.
50
Let's put it
years
that
ago,
way.
I thought I'd be long gone by now.
I'll be gone. Um, Stacey, your question. Fortunately, my clients haven't been asking that much about what's going on, and I think it's just because I've simply beat it into their heads that you can't trade, you can't invest based on geopolitical incidents, moves, anything like that. I've said that for a while now, and I think that bears out. That's bears repeating again. And Shane is right too. If you take a look at it in the context of history, I think us in the media, and I'm going to blame you, Stacey, more than anything, because you're in the media more than me. We make these events sound far more impactful from a stock market standpoint, not from a humanitarian standpoint or anything like that, than they really end up being. I mean, facts are the facts when it comes to this. Iran and Israel and anything in the Middle East, it's terrible what's going on there. But from an actual economic standpoint, it's not going to move the needle all that much. You can point to certain things, right? Whatever happens to oil over the next
Okay.
1 week, 2 weeks, 3 weeks, eventually will work itself out. OPEC will increase supply, US might increase supply, Iran might come back onto the market. I don't know how much outside of China. I think China gets a lot of their oil from Iran, but the rest of the global world, to a degree, they do. But again, that is a minor indicator, or maybe a minor spoke in the wheel of everything that goes on from an economic standpoint. So I wouldn't make any sort of investment changes, altercations, or alterations based on what's going on in the Middle East right now.
So I'm a market participant, but I'm also a market media participant. I'm
Yeah, you're the
on
problem
other.
too.
I know
Yeah.
you can't believe this. I'm on other shows
Yeah.
than
No,
this one.
really.
Okay, but just saying that, what I'm bringing up this, I'm trying to educate the people watching this show, and again, my mom gave me some of the best advice, and it is consider the source. A lot of times, whenever we get bad economic news, bad geopolitical news, the naysayers, the perma bearers, the people that see the glass not even half full, but has never seen water. I'm talking very negative people. They trot them out to be in the media, both regular media and then financial media. But you must consider the source. A lot of these people, if you go and look at their track records, they're terrible. They've, forecast a whole bunch of recessions that never occurred. And as everyone who's an advisor here has said, this is really for the long term. And what we're trying to do is hold your hand through times of turbulence to make you not make bad decisions. So keep a hold of that. I don't really have anything to say about today's good or bad news, but just consider the source at all times about who's talking, what their track record is, and what they really might be trying to proffer, as opposed to being right on a prediction.
This whole tariff thing was supposed to be the end of certainly this economic regime that we're in, and you're starting to see that the tariffs haven't really. Again, there's a lot of negotiation going on, but it hasn't really impacted a ton yet, right? And then that's the two biggest economies in the world, between China and the U.S., and we're still not seeing a huge dramatic impact from that. So it depends on the conflict and the countries involved, I would say.
Okay. Good. All
But
right.
Stacey, you're not part of the problem. I was only kidding about that. First of
Oh
all,
no,
I
no, no. Believe me, I've been told I'm part of the problem many, many times. Well, the Fed meets this week, and we'll get to that in just a moment. But one of the statistics that the Fed likes to use and reviews is the unemployment number. Now, hiring did hold steady in May, but there is some concern heading forward. Businesses may hold off hiring because of the uncertainty over the tariffs, whether they're going to be on, off, and how they're going to affect their particular businesses, supply chains. And also, will the crackdown on illegal immigrants in this country deplenish the workforce in some categories of work? So, Michael, you always are taking a look at the employment numbers. What's your take on all of this?
I don't know, to be honest with you, Stacy. I mean, I think as of now, the two big things to continue to watch are unemployment and inflation. I've been saying that for quite a while now because I think the Fed does dictate a lot, for better or worse, in terms of how the economy is going, how the markets are going to react to that. Inflation continues to trend in the right direction. I'll start there, which is kind of surprising because, as I just mentioned, everybody, all of us market pundits, and as Kim mentioned, all the people on maybe the bad actors, quote unquote, on the news media talked about how inflation was going to really, really ramp up because of these tariffs, but we're not really seeing that play out yet. I mean, will it play out in the next couple of months? We don't know yet. The Fed is really going to be looking into that, I think, over the next couple of months in terms of where that goes. But inflation continues to sort of ratchet downwards at about 2.4%, which is a lot better than where we were, in recent years past. The unemployment rate will likely drop down a little bit, all things being equal, if the outflow of immigrants continues at the pace we're on right now. Now, your point is very valid, I think, in terms of what will companies do on their hiring plans. If these tariffs take hold, if we have a slowdown in the economy, people will generally kind of slow down their hiring needs. But there are a lot of American workers still out there looking for work, and if maybe they fill the void from some of the people being deported from the country. But I think that's to be seen in terms of how that's going to look. But again, I don't know if all that stuff. The economy, U.S. economy, is so big. There are so many people working in it. And this isn't meant to sound cavalier to the people who are being sort of forced out of America, but from an economic standpoint, I don't know how much of an impact that's really going to have on prices, on workers, on labor, all that stuff. I mean, an actual slowdown, an actual recession in the economy will force employers to hold back their hiring plans, will force people out of the labor market. That's generally what causes an economic recession, and will cause the markets to sell off. But things happening here and there, I don't know if it's going to have a huge impact on the markets.
When you see what's happening, Stacy, I'm not sure tariffs is the only reason why employers have held the line a little bit on hiring. We've got a slowdown in the housing market. We've got a slowdown in the general economy. People are blaming all of this on tariffs, and I'm sure that has something to do with it, but that's not the only thing out there. Let's face it, we had a huge amount of stimulus due to COVID, infrastructure bills, et cetera, et cetera. And that stuff's all starting to wind down, so that vigorage, that wind that's been added to the economy is diminishing now. It's instead of running at a gale force, it's only blowing at 10 miles an hour now. So the innovation side of the world will dictate more how the economy grows, and the general growth of the economy will add to employment, which will add to the economy, and it's a self-perpetuating thing if it gets going. Now, with these interest rates, who some people seem to think are high, I don't, they are holding back things a little bit, but employment situation is not as strong as it was. Still not weak, but it's not as strong as it was. And the inflation numbers, as Michael said, are trending down. So I think that there's a reasonable expectation that interest rates should maybe tick down in the next 2 or 3 meetings. I mean, I can't predict what the Fed will do, but they have far more facts than we certainly do. So I think that maybe we'll see, from the facts we do have, I think maybe we'll see maybe a little drop in interest rates before the year's out, let's say, to be bold.
All right. Shana, you have any thoughts on that?
I think as you said, I think the Fed is certainly still focused on employment and inflation. I look at these things and we don't really know what will happen down the pike, but I do think about things like the spending bill. If you take healthcare as a sector, for example, I think it accounted, I don't know if the statistics is pretty close, probably 20 to 30% of new jobs over the last 3 years. And the spending bill, again, we don't know what it will actually entail in the end, but the cuts to Medicaid, it's proposing a $700 billion cut to Medicaid, which, could impact that healthcare sector as it relates to jobs and whatnot. So I think there are still some things out there that, we just don't know, but we keep our eye on those economic indicators that would cause us to maybe make any investment related decision, any changes down the road. So I still think that there's a lot to watch. Also, if we do see the consumer slowing down, you think about things in leisure and hospitality. If consumer slowing, no one's really traveling. So I think there are still a lot of unknowns that we just have to wait for this data to come out.
All right.
Probably one of the larger areas that isn't being discussed right now is recent graduates from both graduate programs and undergraduate programs seem to be having trouble getting jobs. And this is a novelty. I mean, kids were graduating and getting unbelievable offers, right? Especially, I hate to say this, in my old computer science area, companies are beginning to explore using AI. Now, I have to always clarify this. This is not like Wizard of Oz AI sort of things that they really, that it really does do novel thinking, but it's great at pattern matching and repetitive work. So things like coding, where you're just putting snippets together and making something sort of new, yes, I think it could actually drive down the demand for computer scientists, as much as that pains me, especially entry-level ones, but where the advanced one's going to come from, that's a big question. I'm going to get back on the subject here. But also in more kind of just routine kind of work, people answering phones and answering questions, or even email answering things. What today's AI does really well is natural language processing. So if it could figure out what you're asking from a consumer standpoint, and it can answer that, you need far fewer telephone answerers out there. And again, that is an entry-level sort of job. So it could be that we're seeing lighter demand with companies giving AI a whirl, and we'll see how it works out. But I do believe that we will absorb people as the technologies change, because that's what we do. We find new uses for people in different places.
Okay, I like those answers. Thank you very much. Ever since the Fed did raise interest rates, the housing market has been anything but robust. Mortgage rates have remained high, and coupled with record high home prices, it has put owning a home out of reach for millions of Americans. And the ratio of those wanting to buy a home compared to houses for sale has now switched, with more houses for sale than there are buyers. So, Frank, how has this affected the industries or the sectors that are related to housing?
Basically, they've gone down over the last 6 months or so, 10 to 20% as a broad range. So this was anticipated. And what's going on now with the with the growth rate slowing, I think is the best way to say this. All right, there's some tentativeness on making big decisions, and for most people, the home is the biggest financial decision they'll ever make, other than taking a job. And that being said, later, Lennar, one of the larger home builders in the country, is going to report their earnings. It's going to be interesting to see what their earnings are and what they say about the future. But if my thoughts on interest rates from the prior segment are close to accurate, mortgage rates might start to come down a little bit, not a lot. We're not going to see zero interest like we saw a couple of years ago. That I just can't imagine that'll happen again. It was an anomaly. It was a bizarre time. And let's hope we don't have a bizarre time like that again, so they have to do that, because that is bad.
There are two things there, though. I mean, we talk about the interest rates and how hard it is, for people to pay 7% interest rate on their homes, and it's a lot. But to your point, Stacy, if now demand or supply is outstripping demand, then the price of your home comes down. So you can save money or make up the high interest rate by saving money on the purchase price of your home there. I mean, and Frank's right. Obviously, I just took a look at Home Depot and Lowe's compared to the S&P 500 this year. Both are trailing by anywhere between 7 and 13% this year. So you're starting to see the tangential effects of these high prices and the slowing real estate market on those types of stocks as well. But yeah, I mean, again, I think I was just talking to a client about this. I don't even know why you want to own a home anymore. I mean, the amount of work I've had to put into my house over the past year or so, and the amount of money I've been spending on that, it's an absolute money pit. So just stay renting if you need to stay renting. Don't do what I did and buy a house, because it's an absolute nightmare sometimes.
Well, maybe I should take Michael's advice, because I am here the one that has been looking for a house for the last 3 or 4 years, and it's been impossible. But I am looking at least actively here in the Pittsburgh market, so I'm seeing it softening. I'm watching price cuts, and I don't know. I think I think everyone's just kind of in this holding pattern of what's going to happen economically. I think people are afraid to make decisions, but I think it is interesting that I think this is a big gap here about how many sellers versus buyers, and I don't think it's been that big for years. So for me, Michael, maybe I'll just need your advice when I become homeowner. But I want to get out there. I want to build value. I want to build equity. And we've talked about this a number of times. Like, okay, mortgage rates are at 7%, but we all know, when they were 16, 18%, and at some point you will be able to refinance. But it's a lot. People are buying houses. They're stimulating the economy. So we're seeing that as a direct effect in some of those stocks. So it is important to get that moving in the right direction again.
And I just love the whole concept of markets and how they work, about supply and demand. And you can actually point to this and say, look at those prices drop, because maybe you're moving to a different city, you need to sell a house, you're going to have to cut the price that you wanted. So that is a beautiful thing. I also think it does put a little bit of pressure on the Fed, because the absolute cost of the house to most Americans is not what they're looking for. They're looking for, can I afford this payment with respect to my cash flow? And lower interest rates will completely, flip that dynamic away from, oh my God, I bought a X dollar house, to, oh, I can afford this because I have the cash flow, because the interest rate environment is lower. So I think the Fed is very aware of that, and I don't know that that's going to be the primary driver of them lowering rates, but I'm sure it's one of the factors that they're going to look at, because they do want, they're supposed to be able to provide an economy for all Americans, and if young Americans can't get housing, that is a big part of an American experience, is to buy your first house or to buy your next house.
All right, Michael, I'm going to very, very quickly bring this one up. You named it two kind of stores, I guess, Home Depot and Lowe's, or whatever it might be. Could they also be affected by the fear of the tariffs, sort of thing?
Yeah, when you look at like the furniture companies, those got hit way harder. Like the restoration hardwares of the world got absolutely hit hard on that. Kim would probably know better than I would on that. I don't know how many nails and hammers. Maybe they're all made in China. I truly don't know the answer to that. But so I think it's probably a little bit of six one, half dozen the other, in terms of partly from the tariffs and also partly from people. You went through the whole. We've had now 5 years of the real estate boom, and people doing the do-it-yourselfers, improving their homes, and I think that's still really, really going on. I mean, Shana, when you buy a house, you need a contractor. It's going to take a while for them to get you on their schedule, but I think that's probably going to end up slowing down a little bit, and maybe that's part of the narrative as well.
It was just a couple of months ago, as I started to say, that the markets were on edge every time the Fed was meeting. Now the anxiety over interest rates seems to me to have diminished some, and the Fed does meet this week. But also this week we get the latest on retail sales, industrial production, housing starts, weekly jobless claims. Kim, from your perspective, what will be the most of interest to you, or any of these?
All of it.
All of it.
all of it, every last drop of it, because this is the stuff that the Fed actually uses. It's asking the same question that we all are asking. Are things getting better or are things getting worse? And each and every one of those data, even though they are weighted more towards taking action whenever data comes in on housing and unemployment and that sort of thing, they look at all of it, as do I, because I just really want to know where are winners and losers. And all of this data, taken with a grain of salt, and I'll explain what I mean by that, is really important. To try to smooth things out, what you do is you kind of do the last 3-month average or something like that, because there's actual seasonality in some of this, because like let's take construction data. You don't really start many houses in the winter half of the country, the part of the country that experiences winter. In the wintertime, you just don't. So you have to do these moving averages to see if things are getting better or worse. But absolutely all of this is wonderful stuff to look at, and you can get an idea of what direction the economy is going in.
Anybody else?
Yeah, Stacey, I agree with Kim. I mean, they're all really important. And, I think this just shows why, as we're coaching our investors, not to make decisions based on emotion. We really need to bring it back to the data. I think, they're all really important. I think what I'm most interested in this week are retail sales. Looking at the consumer, how much of that, were they buying upfront in the anticipation that they were going to pay more because of tariffs? So maybe we might see a spike in that number. But that really tells us the health of the economy, right? If people are out there spending. The other one is like the housing or the building starts number, to Kim's point. I think that'll be a pretty important indicator, because if that's a positive number, that's just going to stimulate overall consumer spending and the economy as a whole. But this is what we love. We love to look at the data and make sense of it all, and if it impacts any of our decision making on the investment side. But really coaching clients to not make decisions based on emotion is really important.
So, go ahead.
Oh, sorry. No, please, Stacey.
No, I'm just going to pick up from a little bit of what Kim and Shana were saying, and that's, I saw you shaking your head, yes, about averaging these numbers, Michael. I mean,
Yeah, again, that is important, because there are a ton of revisions in the data as well. So when you average it, you kind of are able to look at when they make the revisions to last month's data or the 2 months ago data, that all kind of gets smoothed out over time. And Kim's point is very, very precise, I think, in terms of you have to look at it in the context of, are things getting better or are things getting worse? And if they're getting worse, to what degree are they getting worse? And if they're getting better, to what degree are they getting better? It's really kind of the worst, because the market generally kind of can overreact sometimes to the downside if things don't play out the way the expectations are set for whatever data point we're looking at. But to Shana's point, we kind of love this kind of stuff. Yeah, retail sales and all that stuff. If I ever have a client ask me about that, I'm really pump the brakes here. We'll handle that. We'll take care of that. But it's cool to see that kind of stuff. But again, to overreact to any of these, I think is certainly you can do yourself a disservice from an investment standpoint on that kind of stuff. If things are trending in a direction, that's sort of when you make adjustments to your allocation, adjustments to your portfolio. I think Shane and I, when we talk to clients a lot, it's more of, let's make this tweak here, as opposed to, oh my gosh, retail sales fell off a cliff, let's get out of the markets.
Yeah.
That hurts you way, way, way more often than it helps you.
Okay, good. Great discussion. Thank you. We'll continue our look at investing and the economy in future editions. And since you are watching or listening to this podcast, I urge that you hit the like or the subscribe button on whatever platform you happen to be using. Thanks again for joining us, and we'll see you again in the next edition of The Bull, the Bear, and You.